Okay guys, welcome back to the channel. So it's official, we are in a bear market. There is no place to hide. Across the board, stocks are down, and down pretty hard. I know personally that I'm not looking to sell my assets anytime soon. In fact, I'm doing the opposite. I'm continuing to accumulate cash producing assets. I will admit that it is rather difficult to look at your portfolio during a time like this, and my advice here is to just not look at it. Keep it in the background, keep doing the deposits. Eventually the bear market will be over, we will be back in a bull market, and you're going to be wishing you had another opportunity to buy these assets at a discounted price. But okay, now since we have an official bear market, I want to take a look at risk managed income ETFs and see how they're holding up in this environment. Because the entire point of ETFs like this are to protect you during times of market volatility and provide consistent income. So we're going to take a look at 4 ETFs in total, 2 based off the S&P 500, which is XRMI and NSPI, and then there's sister ETFs that are based off of the NASDAQ. So to begin with the description, for XRMI. This is from Global X. It's the S&P 500 Risk Managed Income ETF, and it employs a protective net collar strategy. So it should give you the income characteristics of a covered call fund while mitigating the risk of a major market sell-off with a protective put option. XRMI seeks to achieve this outcome by owning the stocks in the S&P 500 index while buying 5% out of the money put options. And then for the income, it sells at the money call options on the same index. So that's the technique and strategy of XRMI. And NSPI is the same exact concept, but it's done a little bit differently. So this too has a collar strategy, which involves selling or writing call options and buying put options. But the difference here is that the fund's manager utilizes a proprietary systematic model to manage the fund's option positions, yet it's not tied to specific upside or downside thresholds. And that's the biggest difference between the offerings from Nationwide and Global X. Global X is a lot more systematic, and Nationwide is actively managed. Now finally, taking a look at the price action, we can see that across the board, everything has been going down. The blue line here is the index, the S&P 500, and the Global X, XRMI, is in yellow, and the Nationwide is this light blue color. Now unfortunately, these ETFs do not have an extensive history, but if we take a look at the year to date, this is when the correction basically exactly began. We can see how it played out between all the different funds. We can pull a few bits of useful information from it. So the risk managed income ETFs do have less volatility and a lower beta than their index. And from the beginning of the year to about March, that slow kind of steady bleed off, they didn't offer that much protection. Although something to note is that XRMI did perform better in giving more safety than NSPI. And then in late March, the market did rebound a little bit, and these ETFs were right there with it, again with less volatility in both directions. But then later on in May, when the market sell-off became a lot more sharp and intense, the risk managed income funds did do a lot better than their index. Don't get me wrong, they definitely went down in value, but not as much as the S&P 500. In fact, overall, year to date, the S&P 500 is down 21%, and both of these risk managed income ETFs are down 14%. Now keep in mind, that is just the price action of these funds, which is important, but this is a total return chart over the same year-to-date time period between all the same funds. Because remember, these are risk-managed income ETFs, so the income is a pretty huge portion of the return associated with these funds. But with this view of the total return, the risk-managed income funds are doing even better. We can see year-to-date, the S&P 500 is down 17.5%, and both of the risk-managed funds are down about 8-9%. So overall, I would say these risk managed income funds based off of the S&P 500 are doing pretty okay. They could be doing a lot better, but they are outperforming their index, so they're kind of doing their job. And speaking of the dividend, XRMI currently has a yield of about 10%, and we can take a look at the physical dividend payments right here. They're paying out about 19 cents per share on a monthly basis. And in contrast, NSPI has a yield of just over 7%, and here is their dividend track record. Pretty consistent during this time of high volatility. And really quick, let's do the same comparison, but with the QQQ, which of course has a lot more volatility during this time. So here, year to date, the QQQ is down 31%, QRMI is down 16.2%, and NUSI 27.8%. So here we have a pretty big divergence between the two risk managed income funds. But just like with the other funds, in the beginning half of the year when the volatility was a bit less, they did track pretty close to their index, but holding up a little bit better. But from the end of March, beginning of April, NUSI in comparison to QRMI really began to underperform, and over the past couple of days during that very sharp, intense decline, NUSI basically just fell to bits, and QRMI is still holding up. And if I had to guess, this discrepancy between the two funds is because NUSI and the offerings from Nationwide are actively managed. So to me, this looks like a mistake from the management. And if we take a look at the dividend history of NUSI to figure out what's going on here, we can see that the monthly income has been declining somewhat. Although it's pretty clear that this decline in income does not account for the horrible performance we're seeing in this ETF. And that leads me to think that the active management messed up on buying the put options, because put options give you pretty good downside protection during very sharp market declines. In fact, that's what made NUSI famous back in 2020. We just had another one of these sharp declines in the past couple of days, and QRMI with its systematic approach was covered. It did its job, it protected you from significant sharp immediate losses. But with NUSI, the active management really dropped the ball, and clearly the put option wasn't there when it was needed. So leave a comment down below and let us know what you think of these risk managed income ETFs, especially during a bear market. Are you looking to invest in these? Are they a huge disappointment? Let us know in the comments down below. If you're still watching and enjoyed, give the video a like, go ahead and subscribe, and I'll see you guys in the next one.